Hi, I'm Atre, and I teach entrepreneurship to high school students. And what I'm going to share with you is essentially a step-by-step way of how to think about share market and how that stock exchange and businesses and all of that kind of came into place. And again, this is an oversimplification for sure, but it should ideally give you a really good understanding of how a business is formed and how the value is created, and what is a share, what share market is, what a stock exchange is, and all of those things, right? Even the valuation of businesses and everything. So the question is, what is a stock and what is a stock exchange and what really happens over there? And that's where the conversation kind of began with me and my wife when we were discussing this, and from where this idea of making a video kind of came around. So let me start from let's think of it as stock exchange. If someone doesn't know, it's essentially a place where there are multiple businesses that are listed that you can buy, sell shares of, and all of these things. Now let's start from the beginning, right? Let's try to understand what a business is and how a business really creates value. So suppose if we have a piece of iron ore kept in some place on earth. By itself, that iron doesn't really help us, right? It's a useless, piece of stone almost that we can think of. But the iron only has value when we can make something out of it, when we can utilize it in some way. So a company comes in, right? One person cannot really utilize it so much, right? I can make like one utensil out of it, but for making multiple utensils out of it, it will require more effort. And so a person comes in, which is usually the founder. He says, okay, I'm gonna take this iron and I'm gonna turn it into utensils, right? And and he could do anything. He could make utensils, or he could make iron bars, or he could make something else, right? Utensils is just an example. So now this guy goes to the iron, takes that iron, melts it, makes a utensil, and starts selling it all over the world. Now what then happens is essentially he is now created a mechanism, a machine, a human machine and human organization which is efficiently able to utilize that iron into the form of a utensil that a lot of people are using. And so now this business essentially has some value. Now what does that mean? Now when the founder actually started the company, right, and I'm just using one single founder, there could be multiple people as well involved, but let's take that the person, this guy essentially is a single founder, and he started this company and he owns complete ownership of the company, and so he has 100% of the shares. Now 100% of the equity he has by himself, right? So let's call this the inner currency or the business currency. Now this business currency doesn't really have any value as such, because it's just there, it's just shares in the name of the founder. But essentially what brings the value to it is the idea that someone else is willing to buy these shares, because it will give them, the asset is going to appreciate, or it's going to give them some cash flows later on. So let me explain. So suppose if the founder has 100 rupees worth of shares, right? And how did that come up with? He just put in 100 rupees into the business, and that's what he's thinking, that the business is worth 100 rupees. And let's say he has 500 units of shares, or 500 shares to his names. So 500 shares, and he's putting it the value of 100 rupees on it. So now once he starts this business, does something, takes it to some level, now an investor comes in, or he wants to raise some capital, and so he finds an investor and he says, okay, hey investor, will you buy some shares out of my company? So the inner currency, or the business currency, will you buy this currency that I'm going to sell you for say 200 rupees per share? right? Or sorry, 200 rupees per share. Yeah, let's take it per share. So 100 rupees per share, 500 units that the founder has made or believe is worth it, because that's the amount of money that he's put in. Now he calls in an investor because he wants to raise capital essentially to grow. Now why is he raising capital? So that he can grow the company in different ways. Now growing the company could mean he expands geographically, it could mean deploying more human resources or factories, or a combination of all of these, right? So this is how the value in that business is getting created, by expanding these things. And of course at the same time it should also expand the sales of the company, because that's essentially what matters as well at the end of it. So now when the investor comes in, founder A says ki, hey investor, would you like to give me some capital, and you can buy some business currency in return for it, and I will give you one part, or one currency is worth 200 rupees, and so however many you want it, you can take it at that particular price. And now the business investor, investor is essentially putting in the money thinking that, okay, one, I can earn money out of it. How will I earn money? Because if the business is creating a surplus amount of money or profit, then that profit gets distributed amongst the shareholders, which is the founder and the investor. So that is the possibility that in the future, if there's a business surplus or profit that the business is kind of creating, that will get distributed amongst me. So that will bring me cash flow. Or second, it will increase the value of the asset that I'm buying. So something that I'm buying today for 200 rupees, hopefully in 2 years, 3 years, 5 years, 10 years, it will be worth 500 or 1000 rupees. So one share that was taken at 200 then can sell at 500 rupees, right? So this is the thinking that the investor kind of comes in with. And then he also is looking at, okay, today itself the company has the value, it has the factories, it has some assets, it could be real estate or something like that, which in itself could appreciate over the time and will bring in the value or bring in the worth of money that I've already put in, right? So all of that essentially allows him to de-risk himself, and at the same time hope that it's gonna give him back more money at the end of the day. So okay, he puts in the money, infuses capital, the business expands in different ways, right? It could be hiring people, it could be creating a new line of work, etc., etc. Now a couple of years down the line, now the business again needs a new infusion of capital, and that's when they go for IPO, right? Which is called an initial public offering, which is essentially bringing in more people, mostly public, which is smaller and big investors into the fold. Now this time what they're now saying is, both the founder and the investor are saying, okay, there are 500 shares of the company and we are offering all 500 of these to the public. So that means both the founder as well as the investor are completely going down to zero. That means all of that money is going to come down into their pocket and also possibly go into the company if they wanted to. But that is one way to do it. Second way to do it is also that they, rather than making it 500, now they take it to say 1000 shares. So each 500 shares that the founder and the investor had, now they are making it 1000 shares. That means they split the value and they're still controlling the same percentage as such. Now what that happens is, there's an additional docket, right? An additional percentage that can be now shared with the public. So now out of the 1000, we're only selling 500 shares, and so the rest 500 are still in the pocket of the founder and the investor. Now what that does is essentially it allows more people to kind of come into the fold and buy the shares, and that's how the number of shares, the number of currency within the company also keeps going up and up and up, right? Every time you see that a share has broken or split into two, or it has, sometimes it I don't know what they call it, but it's cut into 3 pieces also. So all of that is essentially ways to increase the number of shares, or increase the number of currency, the business currency, and at the same time make the individual currency, the individual piece, a little cheaper, so that it's easy to trade between people. Now once this is done, 500 shares are now open to the public. Public can now put in the money. They can now bid, okay? They can now bid to get this money into get this share into their pocket. So now they want to buy this. Now how that happens is the company essentially says, okay, 500 of these shares, each share is going to sell at say 250 rupees, right? So founder started at 100, investor got in at 200, and now for the initial public offering, or the for the public, we're now selling it at 250, because that's what the company thinks. Okay, the company is valued at this, where one share is about 250 rupees worth, and so we push it out to the market, saying that, you know, you have to buy it at 250 rupees, and people, if there are enough interested people, that is, there are 500 people willing to buy 500 shares, then it becomes equally subscribed, right? So there is no additional. But if there are say 750 people who want to buy the 500 shares, that means now the IPO is essentially 1.5x oversubscribed, right? So there are more number of people who want to buy that share and lesser number of shares to be actually be able to sell. So that's the idea behind it. And so when that happens, the 500 shares randomly go to different people within that 750 number of people, and that's where the whole idea of IPO allotment kind of comes in, right? That's where the whole idea of you know, luck and chance comes in, that I may get it or I may not get it. So that's the idea behind IPO. Now once that IPO opens up and the company is finally listed on the marketplace, it opens at 250. Right, it opens at 250, which is the price that the company had shared, but it starts trading. Now the stock exchange is essentially a marketplace. It's essentially like eBay, or it's essentially a place where, you know, if I want to sell a company at 100 rupees and someone else is willing to buy it at 100 rupees, that transaction, that facilitation, that hey, I want to sell it at this, do you want to buy it, that whole conversation is kind of handled by the stock exchange, and that's it. That's what it's doing at the end of the day. And so when the company says, okay, we are selling it at 250, do you want to buy it? There are enough number of people, there is 750 people who want to buy it, and then equally it's randomly it gets distributed amongst them. Now amongst these group of people, both the 750 that are here and also the open public who did not really apply in the first go, the stock exchange says, okay, it started at 250, but then if people who got that IPO are willing to sell, so if they're willing to sell it say 250 and someone else buys it, then that's where the trading starts. And so if they're willing to sell it 260 and people are willing to buy it at 260, then the value of the stock rises. And so it goes from 250 to say 300 by the end of the day. And so that's what it said, that by the end of the day, the IPO, you know, whatever, it kind of reached a higher mark as to what the company had shared. So what that essentially means is that the company had undervalued themselves. So they could have possibly sold it for a higher markup, that is, rather than 250, they could have possibly sold it at 300 to the public, and still it would have been bought. So that's the overall idea about it. But anyways, now the company share, this business currency, which has now become a share. When you list it on the stock exchange, it essentially becomes a share of the company. And so this share is essentially now at 300. So founder started at 100, invested at 200, 250 is when the IPO happened, or which it was poised as, and then 300 is what the company is essentially valued at. Now, how does the company get valued? It depends totally on the perception of the company, right? And there are multiple factors as well, but it's purely on the perception. Now, how does that matter? So when it was just the founder and the investor, it was purely on their terms and how did they think, and how's the industry, and how's the business doing, and what's the momentum behind the business, and all of those things, right? If he would be working on AI, then if the founder would have been working on AI, he could have asked for more money, but he was working on iron, and so because of iron he had to ask for less money. That means the investor was willing to give him a lower valuation rather than what he asked for, right? So valuation is just something, it's a negotiation between two people. Now when it's listed on the IPO, or rather the stock exchange, on the stock exchange, essentially how it works is it's purely perception, mass perception, that gets created through press, media, and other such rumors and ways that are there. So if the founder kind of comes on Shark Tank, right, then suddenly the business also gets a boost because the brand is more visible, and that could raise the perception of, you know, people willing to put in more money or buying the share at a higher cost, and that takes the price from 300 to say 310. And similarly, it could be a contract with some big business or whatever business, a new region, all of these things, a news that shares all of these things can take the value of the share. Again, not the business as a whole, just the value of the share can keep going up when there are these particular series of news that can be that are shared around us, right, and around the people. And so that's how you manipulate the stock price, by just creating this mass almost public relations campaign around the company. So you take it from 300 to 350 to 400, however much, just by creating these hype cycles around the business, even if it's not true, right? So that's the hype side of the things. Now, how does the downfall of the business comes around? The downfall of the business actually comes around again through these cycles, but these could possibly be true, or it could just be rumors as well. So for example, if the founder is essentially, you know, has a court case against him or her, right? If he has a court case, then suddenly that news is a negative news, and so people are kind of wary, okay, you know, maybe the value of this business, or this business will not work, or this business might fail, and all of those reasons, and so it goes down. Or there's a new technological trend which has suddenly come up, which changes the trajectory or the trend of the business or the industry. So for example, if in iron, if this particular company was using a particular machine to make that utensil, if there's a completely new machine that comes around which this company is not able to actually adopt, and that is a huge trend, it's going to reduce the cost to a huge degree, then this business is essentially going to fail, because technological advancements really do change the landscape of both the competition as well as the opportunity. And so that is something that the founder of the business has to take care of. But it could also be just it could just be bad publicity, it could be some fire at a factory, it could be agitation, worker agitation against the company, all of these things. Now, these things in itself may not be big, but if there are multiple of these things put together in a short period of short span of time, it could be 1 year, it could be 6 months, it could be longer as well, depending on what kind of business it is. But the more such things happen, the more recognition or realization there needs to be that there might be something wrong underneath the surface, right? But all of this happens, and so the share prices affect. So from say 330, 340, wherever we were, it goes down to directly 200 again, because people who had bought these shares thinking that this is a good business now think that this business is going to go down in value. It does not really have a future. It does the management cannot be trusted, and so on and so forth, and so it goes down in value, and people start selling it even at a loss, right? So essentially what happens over there is, if it was trading at 340 at a point, now as a person who's holding that share, I want to give it back, I'm willing to sell it at 330 as well. And if someone buys it, then the new share price goes to 330. If no one buys it, that means now I have to trade it down further. I need to take it down to 320, so that hoping that someone else will buy it. And every time I do that, I am now reducing the value of the share price. Now, in all of this, the business fundamentals are not really changing, right? These could be hype cycles, both negative or positive, that can affect the share prices. Now, I'm not saying that they can't be true. They can be and possibly are true for a lot of cases. Like for example, in India, Blue Smart, was a really good company, did a lot of good work, people were saying good things about them, but suddenly there was a fraud that came around by the founders, and just after that announcement, the entire company, a publicly listed company, kind of got vanished, right? Similarly, on the other hand, there are other cases where there are other cases, I can't think of anything right now, but yeah, other cases where there are good good headwinds, and that kind of takes the business afloat. Now, what really makes a solid business, or where is the real value getting created? The real value is getting created in, one, the brand of the business, that is the promise that the business is giving to its customer, and is it actually providing and sustaining that promise to its customer. So that means if the business is saying that, hey, we'll provide the highest quality product or utensils to you for your home that will last you a decade or more, if that is the brand promise, is the company able to still provide that quality of product and service? And if it is, then that's a great thing to do. That means the business is strong in one way. Second is it increasing in sales? So that could mean opening up new markets, or it could mean opening up new factories. It could purely be just opening a new market altogether. So for example, this thing, and they were doing so, they were using iron to make utensils. But now, what if the founder thought, hey, like we have the iron, we have an excess of iron ore that is available to us through the supply chain. Can we now use it in some other way? So we can now open a new vertical of creating, these iron bars that can be then sold to construction industry. And so suddenly, all of a sudden, now there's a new vertical, a completely new market, market where they can now sell B2B. That means huge quantities. And so suddenly the business has become supremely more attractive, right? Because there's possibility of more cash coming in, more profits coming in, more stable growth coming in, all of those things. Then there can be other things as well. It could be a huge contract with a company that comes in, which makes sure that there's enough demand for what they're selling, right? It could just mean these utensils, we are going to put it in Walmart, or we were going to put it in Flipkart, or we were going to put it in Amazon for a good 1 year, right? So 1 year contract by these retailers could just mean that I don't have to go to shop, I can just plug into their network, and their network then will sell my product further. So all of these things really matter, and they kind of show the trajectory of the company going forward and how it kind of works out in the end. So yeah, so this is how the business actually creates value. And now that value also trickles down to every layer, because it's not just the founders that are earning, because the founder actually puts in his first piece of money only when the IPO happens, right? Or if the investor is willing to buy some of the shares of some of the business currency that the founder is willing to sell, right? So only then does that money come into the founder's pocket. Otherwise, the founder is rich on paper, or the business is valued at this thing on paper, but in his pocket only the salary that he's drawing from the business, only that comes in. And so all of these things are really important to understand, because that's how these things work. Now, so the stock exchange at the end of the day is essentially a marketplace where you buy and trade these shares, because that's what they are there for. You essentially are now being an owner of a company which might have future potential, and that's what you need to look for. Is there future potential? And that future potential for you could be different. Your future time frame could be 1 year, it could be 10 months, it could be 6 months, it could be 10 years, it could be 5 years, whatever the definition of future is for you, right? It could be different bucket, okay? So it could be just short-term bucket, which is 1 year, it could be medium term, which is 5 years, and then long term could be 10 years or 20 years. So all of these things really matter, because those buckets are really important for you to understand, and then accordingly put in your money into the right form of assets, right form of companies. If you see an AI company coming in which is just IPO'd, or which is about to IPO, then you see, okay, this company can change a lot of things in the future. There are a lot of headwinds or tailwinds behind this particular business, and it will grow and grow and grow, and it will bring you future cash flows, right? Again, the same two things that that were there earlier. One, that if the company makes a surplus, that is, it will make a huge profit in the near future or in the later future, and all of those profits will be shared to its shareholders, including yourself, and that's when you earn that money back. Or the second one was that you essentially have a lot of these I mean, the share that you bought it at 250 rupees goes up in value, and it now is trading at 2500. That means 10x return in, say, 5 years that you're expecting, right? So all of those things are something that you need to factor in, so that you are able to invest into the right places and the right kind of businesses and the right kind of ways. And these are just some of the ways that you could think about it. But essentially what I wanted to share was essentially this, like, what is the stock exchange? How does it really work? What is the business? How does the entire process of valuation kind of works around? And I really hope that this helped you. And if I'm wrong anywhere, please do comment so that I also improve and learn and kind of recreate this video so that I can make it better, because I made this video more so for my own understanding and more so that I get to clear my own head. Okay, this is what the step-by-step layer is. Whereas I'm trying to learn by teaching, and that's the best beauty of it. So yes, if you feel that there's anything wrong, there's anything missing, there's anything that I haven't touched upon, please do share it in the comments, and I would love to kind of incorporate that and add on to my knowledge base. But yes, this is definitely an oversimplification of the stock exchange. Stock exchange today is definitely much more crowdier and much more sophisticated and much more nuanced. There are mutual funds, there are ETFs, there are commodities and options and all of these things that I can't even understand or start to understand, basically. But yeah, this is what I've understood about businesses and about stock exchanges and about IPOs and all of these things, and I've tried to summarize it. I've tried to really simplify it so that anyone else who's probably clueless about these things, just like how I was a month back, kind of gets to learn these things and hopefully get something more concrete and tactical and valuable out of it. So yeah, with that, I will see you in the next video.